Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Joining me now is Derek Myron. Derek, how you doing today?
I'm doing great, RJ.
Excellent. I see you have a guest. Why don't you do the honors and introduce your guest?
Well, let me introduce my special guest today. His name is Eric Wallace, not to be confused with William Wallace. Mr. Wallace is a CPA and does some specialty tax work for some of the ultra high net worth families that we serve. And so, Eric, welcome to the show.
Thank you, Derek. Thanks for inviting me. It's an honor to be here.
Absolutely. And I kid CPAs, they typically don't have much personality, but Mr. Wallace here is unusual in that aspect. He's quite the joker as well, and so I really enjoy Eric as a person. So let's get right into it. Why don't you tell, well, I guess before we jump right into it, who is this podcast for? It's for ultra high net worth individuals and families and the professionals that serve them. And when I describe ultra high net worth, I'm talking people with $20 million balance sheets and higher. That's really who these strategies really apply to. And so with that, the lawyers want me to say some things I'm going to skip right over. I'm just going to jump right into it, Eric. Why don't you just give us just quickly 30 seconds about you and your background and your firm, and we'll just get right into the topic.
Okay, sure. I've been a CPA since the 70s. Looking at me, you can't tell. You would think I just got my license last week. One time I had my picture up on a seminar, and somebody in the audience raised their hand. I thought they were going to ask a serious question. And he said, "Hey, is that a picture of you when you were a fetus?" No. That's a recent picture. But we specialize in tax method changes. And there are certain parts of that as our CPA and engineering practice where we look for businesses and individuals who have the potential opportunities for us to provide to them tax deductions that they're not aware of and their CPAs aren't necessarily aware of. And we've been doing that for multiple years. I've been filing applications for the IRS and arguing and dealing with the chief counsel's office for years. So we've really developed a very specialized practice. I am also the author for the world's largest publisher for their audit programs for the construction and real estate industry and for tax research that a lot of attorneys and CPAs use under the, I guess, their copyrighted name, IntelliConnect.
Okay. You are author and foremost expert about the subject we're going to talk about today. Let's give them a high-level flyby of what we're going to talk about. It's going to be 3 sections today. We're going to talk about cost segregation. I think a lot of people know about that or have heard about that. Then the second thing we're going to talk about is tangible property regulations. Not many people probably know about that. And then the third thing we're going to talk about is a change in accounting method in filing private letter rulings. We might touch on that a little bit, maybe a little bit too deep for a 30-minute podcast today. But let's see how far we get. And anyway, those are the 3 things we're going to talk about. I'm going to ask Eric a bunch of questions about that, and then we'll wrap up. Sound like a winner?
Let me first talk about all these are under the umbrella called tax method changes. And you might want to ask, well, what are tax method changes? Well, whenever Congress writes a law, they say to the IRS, you write the regulations for this, you put out the proper notices for this so that people can comment back. And that's a due process that's mandated and required. So in the process of a taxpayer preparing their tax returns, they often have choices. And those choices are their elected or employed tax methods. So everybody thinks, well, you're just talking about cash or accrual, Eric, aren't you? Those are the basic tax methods that are disclosed and asked on the business tax returns. But in reality, a taxpayer may be employing dozens of tax methods. So when Congress wrote the rules about how to recognize revenue or how to recognize or employ a deduction, they came up with a master section saying the IRS is in charge of tax method changes. So if a taxpayer wants to employ a method, it's dictated by how the IRS sets up the procedures. And if they want to change it, they have to ask the IRS for permission. Why? Because they're in charge.
Okay, let's help define this for the audience. The people we're talking about ultra high net worth folks. Now we're talking about ultra high net worth folks who either own a business and are running a business or have significant real estate holdings, both commercial and possibly residential. Those are the two groups of people we're talking about. Anybody else that's in those groups, Eric?
Well, we want to talk to somebody who owns a business that is a service provider as well. And 75% of the U.S. GDP are service providers. As a CPA, I'm a service provider. Derek, as a high net worth advisor and investment and so forth, you're a service provider. So medical doctors are service providers. Your health club, service provider. Construction contractors, service providers.
So let's bring it down. Let's start with the very first thing, which most people have heard of, is cost segregation. So the history, right? There was a famous case, the hospital versus commissioner back in 96. They filed this thing and basically said, this building, I'm sitting in an office building, is not going to be depreciating this over 39 years. You get to put some in land and some in building. And they said there's no way that the lights are going to last 39 years. They're going to wear out in 7. The carpet's going to wear out in 5. And they won the case. And the judge in the case said, great, if you, Mr. Taxpayer or Mrs. Taxpayer, have a building and you want to accelerate the depreciation, you have to have an engineered study to accelerate the depreciation. You can use bonus depreciation, but essentially take all those assets, put it in 5, 7, and 15 year, and then hit it with double declining balance and whatnot. That's what a cost segregation study is. It's been around since 97, and we're 27 years later. Who's using it? Who's not using it? And why not are they using these things?
Okay. Yeah, I mean, it was that court case was very interesting because, prior to the Tax Reform Act of 86, people took a building and they did what was called componentize a building. So they would say, hey, my elevator's going to last 50 years, but my lights are only going to be 20 years. And so they would tear apart a building and put their own class lives in. So the IRS came out with rules that said, nope, you can't do that. You could no longer employ componentized depreciation. In fact, here's our document that says you can have 27.5-year class life for residential, like apartments. Now it's 39 years for commercial property. And the hospital court case said, okay, we can't componentize it. Well, we're not componentizing it, but we're telling you that different things have different class lives. So we are able, with engineers, we employ the engineers directly to come up and say, look, if you walk into a conference room and you see 5 different sets of lighting, you might come in and have the main light. Then you might have some cans around the end of the building. You might have some lights that shine on art or on a board that you write on and so forth. So the IRS has said you need one set of lights that are classified as 39 years. All the other sets of lights can be classified as 5 years. So this is how we tear apart a building into 5-year or 7-year class life, and the landscaping around the building, the parking lot, the landscaping, as 15-year class life. And we're able to take a commercial building that would normally, without land considerations, of course, from 39 years to shorter class life, maybe an average of 20, 22 years. Everybody in America, just about every tax advisor anybody involved in real estate says that doing a cost segregation is a no-brainer because it'll accelerate and you'll be able to enjoy quicker deductions rather than a 39-year. And it's a commodity, though. There are hundreds and hundreds of people, if not even thousands of businesses or CPA firms that offer cost segregation studies.
100%. And I think I read something from Ernst & Young, though, only about, tell me if you've read similar things, that only about 30 or 33% of all commercial buildings are cost segged. And so I get it if you're a nonprofit and you own the building, that's a different, but there could be some reasons why, or I don't know why there isn't a higher penetration after being out there 27 years.
Cost seg is optional.
Yep.
And some of the reasons are, let's just say I'm a physician making, good money every year, and I decide as part of my investments, I'm going to buy some apartment buildings. And if that apartment building, if we go in the first year that somebody buys or builds an apartment building and we accelerate depreciation, we may end up with a loss for that rental property in the doctor's tax return. And because it's classified as a passive activity, the doctor really can't enjoy the benefits of a cost segregation. So oftentimes taxpayers will wait. They'll wait until maybe they've got the building paid off, or interest rates have really dropped, or they're really generating income now. Now they want to employ a cost segregation, and that could occur 5, 10, 15 years after they've actually put that building into service.
Yeah, so those losses could be suspended, and so why incur the cost to put that?
That's correct.
So
That's correct.
I think a lot of people know about that. The fees are pretty commoditized in putting those together, and I don't think we're spreading a lot of news with that. Let's move to the second topic, which I think is going to take the majority of our time today, which is TPRs. And frankly, I hadn't heard about it until this year. I thought, who is this Eric guy with tangible property regulation? Couldn't wait to look it up. Looked it up like, So I see that there was proposed regs put out in 2012. They got finalized January 1st, 2014. And I've been learning this from you and others about this strategy. And why don't you tell us what the heck are TPRs? Why do I care? And what do they do for me?
Cost segregation, optional at the time you build or buy a building. The tangible property regulations, the TPRs, deal with every work effort you employ on that building after it's placed in service. So they are, you could call them the repair and maintenance versus capitalization rules. So it took the IRS by 2014, when the original code came out in 1954. So between 54 and 2014, what is that, 60 years? It took the IRS 60 years to finally come out with the rules, principles, tenets as to whether a work effort should or should not be capitalized. I've been preparing tax returns for a long time. And, I'd have somebody come in my office and say, I got this single family rental property, and I've owned it for a long time, and I spent $10,000 replacing the shingles on the roof. What should we do with it? And as a CPA, we'd say, $10,000. We better capitalize that and start depreciating that over 27 and a half years. And we did that. And we did that because the IRS agents would come in and argue with us and say, $10,000 is a lot of money, you better capitalize it. There were no rules. There was no guidance for either the IRS or us CPA tax return preparers as to, should you or should you not capitalize that? What's the criteria? And beyond that, there were a lot of court cases that dealt with capitalization versus repair and maintenance. And finally, the IRS got to religion and said, you know what, instead of having all these fights between the agents and the tax return preparers, why don't we establish some rules? And so they came out with the tangible property regulations with the criteria that says whether something should or should not be capitalized. And that's what we employ. They're mandatory, though. And what I mean by mandatory is they also came out with, at the same time, with a regulation that we deem called the use it or lose it rules. And under the use it or lose it rules, the IRS has said, if you capitalize something that should have been written off, or you write something off that should have been capitalized, then you're violating the IRS rules and you're manipulating your income between the years. So if you capitalize something that should have been written off, the IRS has the big threat to come back and say, I'm not going to allow you to capitalize that. And I'm not going to allow you to take the depreciation on that item because you should have written that off years ago.
So their assumption is, oh, maybe you had low income, so you capitalized it to take it in future years. And if you expensed it and you should have capitalized it, maybe you had high income now and you wanted to expense it instead of capitalizing it. So they're going to argue the opposite of whatever you did. Yeah,
that's right. They often will. And these things, while they're mandatory, they are taxpayer friendly in that if you've got let's just say you bought an apartment building 15 years ago and your depreciation schedule now is 3 or 4 pages long because every year you have, I spent $100,000 this year on, maybe I replaced an HVAC unit. Maybe I put some new carpeting in the building, or I went in and gutted a bathroom or redid the kitchens. If you got a depreciation schedule of 3 or 4 pages, I'm just telling you it's wrong.
Well,
because you've capitalized too many things.
So that is what you're saying. And I'll bet more often than not, that taxpayer argued with their CPA and said, why couldn't I expense this? And they said, you absolutely have to capitalize it. Now you're telling them, wait a minute. The taxpayer was probably right way back when?
Yep.
If this happened 2014 to present?
Yep.
Yeah.
And then here's the other part of it, though, Derek. When the IRS issued this in 2014, they just didn't say, okay, here are the new rules. Why don't you apply them going forward? They actually told all the taxpayers, scrub your depreciation schedules and go back in time and write off assets that are on your depreciation schedule that should not be.
So they did not time bar going back.
That's correct.
Number one. And number two, in order to go correct the past, you don't have to file an amended return. Is that right, Eric?
Yeah, this is not an amended return, but you do have to do an IRS change in accounting form and attach it to your return. So the good thing is you don't want to amend a return. Imagine if I've got a partnership with 10 partners owning an apartment building. There's no way I want to amend returns and issue 10 different K-1s for multiple years in the past. It's current year.
That's great. That's great. It also doesn't undo those statutes that are running, right? So that they can't come and audit.
That's correct.
Things. So
yep.
There's another benefit I learned about this over cost seg in doing TPRs versus cost seg. And I was shocked to learn this piece.
And you're talking about recapture and non-recapture?
Yeah. I mean, that's a dirty word in depreciation.
Yeah, it is. So when you implement the tangible property regulations and you say, like, for example, I was giving an example of the $10,000 shingles that were replaced on a single family home that was owned for years that was rented. The IRS and their regulations in the TPR regulations actually say, if you replace an item that has deteriorated during your ownership and you restore that item to the condition that you started with, then that expenditure is not a capitalized event. So my $10,000 in shingles should have been capitalized. And let's just say I did put it on the depreciation schedule 10 years ago. And I still have, because it's a single family, it's 27 and a half year depreciation. I still got 17 and a half years to depreciate that $10,000 item. The net remaining depreciable basis of items that should not have been capitalized in the past become a current tax deduction.
I mean, does this sound like music to taxpayers' ears?
It's the carrot and the stick.
I don't think you're making any friends with their existing CPAs, though. They're like, this is contrary to Eric, to what I've been training my clients to do.
Yeah. And so you're going to get resistance a lot of times from the CPA. And if you ask the CPA, are you employing the TPRs? There's an annual election that we do on the return, and it's called the de minimis safe harbor, DMSH. And under that de minimis safe harbor, it essentially says if you have any event or item that's $2,500 or less, just go ahead and write it off. You don't even have to test it or anything. So I happened to buy an air conditioner. I don't know how you could these days with the cost of everything. That was $2,000. Well, you don't even have to employ the criteria of capitalization versus repair and maintenance. You just write that $2,000 off. So if you ask the CPA, are you employing the TPRs? They may think of the de minimis safe harbor, and their automatic answer is yes. But in reality, we're talking about much more than the annual de minimis safe harbor election. We are talking about, were your depreciation schedule scrubbed? And did you employ the capitalization versus repair and maintenance criteria when an item was decided to be put on or not to be put on that depreciation schedule over every past tax year?
Well, let me share a little story. So I met Eric earlier this year, and our firm has done a lot of real estate investing, several $100 million in real estate transactions and cost segs. Never heard of TPRs before. So I decided I was going to test Eric with a few clients. And we took a smattering of clients. The first one was a billion-dollar family out in the East Coast. And they have a CPA on staff who's been there for a lot of years, 25 years. And I picked the four. I said, look, let's not give him everything. Let's just give him these 4 returns. He just needs the depreciation schedules. I really love the CPA who's on staff. He's like, Derek, I've done all these for years. I go, do you want to check it out or not? He's like, let's check it out. Send it over to Eric. It came back $5.5 million in missed deductions. He about fell over. He's like, I cannot believe this. So he had to dig in with Eric, and then they got one of their plant managers to dig in, and then they had to look at their income, and they decided they're in the process. We haven't put it together yet, but we're going to do half of it this year and half of it next year based on their income, and they're over the moon, right? They're going to save $2 million on these 4 transactions, and they're pretty darn excited about it.
Yeah, I mean, a really nice CPA internally do all the returns, very much overwhelmed, doing so much work for the family. And Derek, you remember, he came back and said, look, there was nothing there. And we said, it doesn't take any time. Just share the depreciation schedule. Just share it. And if there's nothing there, we'll agree. But I've heard this so many times before that there's nothing there. And when I came back and said, you got a $5.5 million deduction at the low end, we went offline, and me and the CPA talked, and I explained it, and he got the religion after that. He understood. Yes, absolutely.
I took it to somebody in my family who runs a very large construction company, and your initial findings came back at $5 million for him. I took it to another one of our clients here in San Diego, a downtown property. Came back at $1.2 million. It was a $20 million property. Came back at $1.2 million deduction. We've got several others. We have yet to strike out. He's yet to send us one back to say, no, there's no value there. I think we do a little bit better job of scrubbing to give him the right ideal folks. But where it fits, we are seeing fantastic results. We're just now going to start putting this all together and start filing the returns. We haven't filed any returns yet, but pretty darn excited about the strategy. That's TPRs in a nutshell. We got to look at prior year tax return. We got to look at the depreciation schedules. We can then from that discern, is there potential an area to an opportunity to dig into, and that's when we get Eric involved and see what's possible, and then figure out, all right, we're going to create these deductions. How are we going to best use them in an optimized way? So
That's correct.
There's a little bit more to it, but just high level. Anything else we should share about TPRs before we move on to the last topic?
Well, what do we need to look? Really, all we need is the federal depreciation schedule. We don't need their tax return. And a lot of times people share the tax return, assuming that the federal depreciation schedules are included. They aren't necessarily included. So we need to see the federal depreciation schedule and the address of the building or buildings. But the other thing we need to do is oftentimes you're going to have to overcome the CPA objections. Do you want to talk about that, Derek?
100%. That's what we have found is the fly in the ointment, because it's contrary to the advice being rendered for all these years, right? And they've gotten their clients accustomed to capitalizing assets even when they wanted to expense them. And so this is music to the ears of the taxpayer. There's a little bit of, it's too good to be true. And I was in that camp as well. But the more you dig in, the more you realize what's going on here. And you can dig in and there's lots of corroborating evidence that supports the position here.
Yeah. And I try to allay the fear of the CPA to say, look, we're asking for this schedule, not because we want to replace you as the tax return preparer. We're just specialists in this particular area. We're here to help. And hopefully we get past those objections and we can move forward. But the other thing is, one final thing is, who does this apply to? I don't care if you're a bank. If you're a bank, you got branches. All those branches probably have capitalized items that don't need to be capitalized. We've done it for somebody who had 20 different locations for a body shop. We've done it for certainly a fast food chain. Somebody owns 30 or 40 Burger Kings or McDonald's. Just think of anybody who employs real estate in their business. And just about any business has real estate.
Yep. And has a big depreciation schedule. That's right.
Yeah, and that doesn't matter if it's just leased space or owned property or both. So usually the bigger, the better. Yep. And certainly somebody who is so big that they only employ, they do their own tax returns in-house, and they only do that. We often find that is where it's missed the most, as opposed to a big CPA firm taking care of your depreciation schedule.
We covered high-level cost seg. We just got into TPRs. Let's in brevity, let's talk about the third and changing an accounting method and filing a private letter ruling. What the heck's a private letter ruling? Why would I want one? What does it cost? What can it do for me?
If we get to a very high annual net revenue type of business, in order to change accounting methods, the IRS has set up two avenues. One avenue is called automatic methods, and they've identified about 250 automatic methods that you can change, and you could change up until the time you file your return, even under extension. So it's like 250 most common methods. The other avenue is non-automatic method applications. So what we look for is in a service provider, and we want a service provider that's doing 40 million, 50 million or more. And we like to eyeball the tax return because they could be employing tax methods that are not offering them the most deferral of revenue or employing the best deductions that the tax code offers them. So non-automatic can only be filed up until the end of their tax return to apply to that tax return. Non-automatic, I can do it the following year and so forth. But the reason we do that is because why prepay your taxes if I can find, and I am aware of a different tax method that you can employ that would offer you a $1 million, $5 million, $10 million, $20, $30 million deferral of revenues. Think of the tax savings related to that if you're located in a high tax state like California or New York or many of these other jurisdictions. Essentially, I argue that if you're not employing the best deferral tax method for you, and I'm telling you, this is not at risk, because if the IRS issues a private letter ruling, Derek, you got a golden ticket.
Yeah. So let's make this simple. We're talking about service companies who have revenues north of 50 million. If you can identify a tax method change strategy or two, you will, at no cost other than the filing fees to file the private letter ruling, will understand their business, draft this private letter ruling documents, send it off to the IRS, and they will either agree or disagree. And if they agree, you've got that golden ticket. And that golden ticket is to continue to defer that income so you continue to kick that can down the road, and we'll have other strategies to mitigate or eliminate or continue to defer on a go-forward basis.
Yeah, you continue to kick it down the road unless you sell your business in an asset sale, unless you shut down your business, unless you greatly decrease in the deferrals. But if you pass your business within the family, if you sell your business in a stock sale, if you move all or part of your business into an ESOP, those are all permanent deferrals.
So there's fantastic exit strategies. There's some strategies that are just time value money deferrals. So there's some of both here. It's way beyond the complexity. The complexity is way beyond the scope of this podcast today. So we are at the end of our time today, Eric. I would love for you to offer your closing thought to the audience, and then I'll wrap it up.
If you share, we're going to be able to tell you whether these opportunities exist for you. So for TPRs, it's just a copy of your federal depreciation schedule. For revenue deferrals, it's going to be a couple years of tax returns and financial statements for an initial assessment, and then we can go into detail after that. Fees for TPRs, very small percent of the tax deduction. For the private letter rulings, small percent, only if the IRS approves it. And that process can take 6 to 9 months. So we're not here to say, boy,
it's a pay-to-win strategy.
Yeah.
So
if you win, you get it. If not, it's no problem. We'll spend all of our time. But based upon our history and knowledge of filings, we're going to know whether it's going to get approved before we submit the document. We'll have extreme confidence not to waste your time.
Mr. Wallace, so appreciative of all this valuable information. We are seeing this applied to our clients in a big way, and we are looking forward to filing these returns for 2024 to get fantastic results. If this is of interest to you, please contact us at the Live Life Liberated podcast. You can send me an email at dmyron@centurawealth.com. That's CENTURA wealth.com, and we'll get you fixed up. RJ, why don't you take us out today? Did you learn anything?
I learned a lot. I always learn a lot when I listen to you guys. Just tremendous amount of information. All right. Thank you. And most importantly, thank you for listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you've not subscribed to the podcast, please click the subscribe button below. This way, when the team comes out with a new podcast, it will show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Centura Wealth Advisory, I'm RJ Malik, reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory, Centura, is an SEC-registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC-registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.